Welcome to the Passive Mobile Home Park Investing Podcast with your host, Andrew Keel. This is the podcast where you can get the education you need to invest 100% passively in the highly profitable niche of mobile home parks.
Welcome to the Passive Mobile Home Park Investing Podcast. This is your host, Andrew Keel. And today we have an amazing guest in Mr. Ryan Murdock from Open Door Capital. Before we dive in, I want to ask you a real quick favor. Would you mind taking an extra 30 seconds and heading over to iTunes to rate this podcast with 5 stars? This helps us get more listeners, and it means the absolute world to me. So thanks for making my day with that review of the show. All right, let's dive in. Ryan spent 10 years in the semiconductor manufacturing industry before transitioning to real estate investing and property management in 2007. Since then, he has steadily acquired a solid portfolio of multifamily rental properties. He has extensive management experience in many facets of real estate, including retail, office, multifamily, HOA, and especially our favorite mobile home parks, including nationwide consulting and turnaround projects. As a co-founder of Open Door Capital, Ryan played a critical role in early operations and assembling some of the experienced team they have today. He continues to provide value through an ongoing advisory role and targeted projects. In his spare time, he's an avid scuba diver and adventure seeker from his home base in Maui, Hawaii. Ryan, we are excited to welcome you to the show.
Hey, good morning, Andrew. Thanks for having me on. I really appreciate it.
Yeah, it's afternoon my time, dude.
Oh,
Hawaii
sorry.
time must be morning, right?
Yeah, I'm always behind the curve.
Awesome. Well, maybe you could start out. I'm excited to hear your story and how you got into manufactured housing communities.
The experience of multifamily started with a management company that I'd started probably 2007, 2008. I was buying some small multifamily stuff, kind of started my own property management company as a complement to that. Also was a real estate broker for 10 or 12 years. But I found that as I was expanding my management business, there was a real need for mobile home park management. There were a lot of mobile home parks in my area. Nobody was managing them well. I really didn't have any relevant experience, but took on a couple of small parks here and there and steadily grew the number of parks that I was managing and the size of them just through just a lot of trial and error, as much as I hate to admit it early on, but got some pretty good systems in place and was certainly doing it better than anybody else in the area. So it really just grew from there.
That is fantastic. And that was up in the Northeast, if I recall, right?
Yeah, I was based out of Maine originally. So everything around the Bangor, Maine area, we had several hundred units, which actually we grew to several thousand units over the course of 5 years. And 8, 10, 12 mobile home parks in that mix.
Wow. That is fantastic. And maybe you could tell us a little bit about Open Door Capital, what you're working on now.
Sure. So that's kind of been where I focused my efforts over the past 4 or 5 years is partnered up with Brandon Turner, who 5 years ago was very vocal in his search for a mobile home park. He wanted to start investing in that asset class. And I actually had found a park in my area that fit his criteria. Sent it over to him, and long story short, we ended up partnering on that, and that was my first real equity piece of any mobile home park. I'd owned other properties, obviously, and managed other mobile home parks, but that was our first foray into actually buying one. And I think we bought that right around January of 2018. We owned that for about a year. It was a real value add project. It was a smaller park, but heavy value add, real heavy lift. But it worked well. I was kind of the boots on the ground, did a lot of infill and some improvements, and we sold that park just after 2 years for really strong return. I think we paid just around $1 million for it and sold it for like $1.8 million. And all the improvements and everything were done out of the cash flow of the park. Didn't really require much additional capital from us. So very small park size, but it was a test bed of like, hey, this model actually works. Let's take this show on the road and see what we can build from there. So in the past 4 years or so, I think we've acquired just over 35 parks. We've done 6 funds, 506c syndications where we raise investor capital. We've got around, I think it's 5,500 lots and probably 250 million in acquisitions for mobile home parks, in addition to the multifamily stuff that we do as well.
Wow. That is such an awesome story. And literally, it was just like a cold outreach, right? To reach out to Brandon. You just had heard him on Bigger Pockets and just said, hey, I got a deal. Let's talk.
Yeah, and I've told the story a million times, but that was very much outside of my normal comfort zone, is to like reach out and communicate with other human beings, especially over a deal that I thought was kind of a Hail Mary. Like, there's no way he's going to want this, but just goes to show, get out of your comfort zone and do those uncomfortable things, make those connections, continue to network, and big things can happen from
it. Big things for sure. Let me ask you this. What do you think is the toughest hurdle for most operators in mobile home park ownership?
I think there's this perception that mobile home parks are very easy to manage. You hear about, hey, the tenants own their own homes. They're in charge of all their own maintenance and repairs. It's really easy to manage these things, which is the goal, and where some parks can certainly get to, and that's what we strive for on all of our acquisitions. But I don't know about you, but I've never had one start out that way. They're always some sort of train wreck taking over, especially if you're targeting value add stuff that requires infill, or maybe it's been a mismanaged park, or, that kind of thing, which is where a lot of the opportunity lies to make a lot of money, but they are very management intensive, or can be. I think we have some excellent systems in place. We have some amazing people that do the hands-on management. We're vertically integrated on the mobile home park side. So we do everything in-house, but man, it's a lot of work, and people get into it just thinking they're going to do it, quote unquote, passively as a part-time gig. A lot of them are in for a rude awakening on just how much work it can take.
Yeah, I totally agree. That's the number one thing I would say as well, is the management is not passive. It is very active. You have to be hands-on with it, or it'll run away with you. Like we try to visit all of our mobile home parks every quarter, and within that 3-month span, you could show up and there's appliances on the roads and hiding behind homes and things like that. And we do drive-through videos every month, but it's just the stuff you don't see from the drive-by that adds up, and it can get out of hand real fast. So
for sure, yeah, it's a real slippery slope if you're not right on top of it.
Totally, yeah. So I know you've done a lot of value add parks. What would you say is the hardest value add component in mobile home parks, and why?
I think recently it's just been sourcing homes. So our target park is generally 60 to 70% occupied. So, say on a 100-lot park, we have to infill 20, 30, sometimes a few more lots. And, pre-COVID, I think it was easier to source mobile homes, whether it be used or new. Certainly since COVID and supply chain issues, the new ones, the waiting list is a lot longer for those. You might previously be on a 6-month lead time, and recently it's been 12 to 24-month lead time. We found some avenues to try to skip to the front of that line a little bit, but that's certainly been a challenge. And then, of course, as mobile home parks in general have become more popular, even sourcing used homes has been more of a challenge. Everybody wants to do it now. So, we're scrubbing, wholesale lists. We're, keeping our eyes on all the Facebook marketplaces local to our parks and nationwide. So we're certainly getting it done, but it's been a little more of a challenge for the infill piece over the past couple of years.
Yeah, I agree. What would you say is the opposite? What's the easiest, value add component? And
the easiest would be to just taking over poorly managed parks. You walk into a place that has been poorly managed over the handful of years prior to our ownership, and that's like the easiest low-hanging fruit is, whether it be the tenant relations or your rent collection procedure, or just sometimes it's, you take over stuff that was dealt with on a handwritten ledger and bringing in some actual management software and systems, and some consistency and leases and rules and people that are able to implement those and follow through with a large amount of consistency. I mean, just that alone can add a tremendous amount of value to your park, even if you don't do any infill. Just go in and clean up the management efficiencies. And again, it's a ton of work, but we have great people and great systems, and that's the easy, right from day one, we can start turning that stuff around.
Yeah, I think that's one thing about mobile home parks as an asset class. Having so many mom and pop owned, parks, there is a lot of meat on the bone. So that's really good that you guys have those systems down and can improve those. What would you say your mobile home park investment strategy is today, and how has that changed over your years in the business?
I think we're definitely targeting larger and higher caliber parks. I mean, we still want and need that value add component for it to make sense, but I'm seeing definitely an improvement in the overall quality of the parks we're buying. If you look back to our first fund versus we're about to kick off, I think our 7th fund, and we've already got some things in the pipeline for that. And it's just a higher quality of park, and there's probably a few different reasons for that. I mean, certainly we're much more established these days in the eyes of the brokers. And as you know, it's a very small broker community that deals with these larger parks nationwide. So I think we're getting a closer look early on at some of these things before they're shopped widely or certainly publicly marketed. So we're getting an opportunity to bid on some of those right out of the chute. Our management has gotten a lot better. our margins on that are slimmer, so we're able to maybe buy at a little higher price. We're getting better debt terms with some lenders that we've got established relationships with. So certainly going after higher quality parks with slightly higher purchase price, but the projections on those are good, and the management should be a little easier because they're not quite as heavy of a lift.
Just to repeat some of those things you said, because I think a lot of people know that the bigger firms go after these larger, better quality parks, but they don't really know why, like how it makes sense, right? And I think some of the things you said is, hey, the management should be easier, right? Because you should be able to pay an on-site manager more, and that's part of it. You should get better debt terms, right? Because you're able to get more capital out, and typically banks, want that. They want those higher loan amount deals, and then because your management systems are better, your expense ratios on the management are probably a little bit lower, so you're able to kind of pay up. Where other groups that don't have the scale and they don't have the team and the management fee side of things, they probably couldn't afford to do that.
Yep, certainly. And now that we have as many parks as we do, and that continues to grow, just proximity to other parks will pique our interest or allow us to maybe pay a hair more for a park if we've got another one or two right down the street. So we can share sometimes managers, and if not, then definitely share some of the efficiencies by tapping into systems and the maintenance guys and the rehab crews and all the systems we have in place in one specific geographic area. Certainly makes it much more appealing to go after something else that's very nearby.
Yeah, I totally agree. I mean, just having all of those contractors that you've worked with before to be able to start brand new, versus starting from scratch somewhere brand new is such a big deal. Maybe you could tell us a little bit about the management company. Like, what does that look like? How many team members is there? What type of divisions do you have? Do you have like regional managers that are like in parts of the country, or because I think you guys are fairly spread out, right? You guys don't target like one specific area.
No, we're really spread out. I mean, we prefer kind of the Southeast Sunbelt stuff, but we have parks everywhere from Florida to Alaska and everywhere in between. So certainly all the parks, of course, have on-site managers. And as we all know, their skill level varies. Usually it's pretty basic in what they're able to do, but we've got some great people there. All of those on-site park managers are overseen by regional managers. Who are the bulk of them are based kind of out of the Atlanta area, but we have certainly regional managers all over the country. A lot of people are working remote, never have seen the inside of our office, and we're fine with that. And all of those are overseen by our VP of property management. So we're Open Door Capital. We've got a completely separate. It's Open Management, which is the property management arm. It runs as its own freestanding company. Obviously, we're sharing resources across Open Door Capital and Open Management, but that's a freestanding entity. It is nice that since we do manage all of our own stuff, our property management company doesn't necessarily need to run at a profit as would if you're owning parks all over the country and you've got to hire third-party management. Number one, you might not be able to find anybody. That was certainly a decision we had to make early on. It's not like buying tires where you can just go to the store and pull them off the shelf and they're the same as everywhere else. Sometimes you might find a great deal on a great property, but there is just not any viable management options there. So no better way to ruin a good property than to put a bad property manager in there. So that's why we built this out. But our property management company really, if it runs at a break even, we're okay with that because our goal obviously is to increase the value of the properties themselves. So it's not like we have to run that property management company at a significant profit. As long as it's break even, it covers the overhead, we're good, which makes us a little more competitive when we're offering on stuff because our property management definitely costs us a little less than it would if we were going out for a third party management company.
Yeah, no, that's awesome. Yeah, we do the same thing. Where do you feel is the best opportunity or strategy right now in the marketplace for mobile home parks and mobile home park investing?
Yeah, it's a strange environment out there right now. I mean, I don't know what you've seen, but we're seeing things retraded a lot. We've always kind of prided ourselves on both the mobile home park side and the multifamily side of like we don't retrade. We're not there to bait and switch, and the brokers certainly don't like it. It just wastes everybody's time. But in this environment, both on the buying side and trying to sell things, there's been a lot of retrading going on from people, not just us, but other operators that wouldn't necessarily retrade that really have to. Whether it's their debt chain terms are changing, uncertainty in the market. There's a lot of different factors right now, but I think still just the ability to get it done, and if on the couple things that we have had to retrade, like there's been really solid reasoning behind it, and we're still able to close. So we've certainly seen a lot of deals just fall out of market. Like they just can't or won't get it done. So the brokers are bringing them to us saying, we know you guys can make it happen. And I think there's a lot of opportunity there where other buyers just can't push things across the finish line for one reason or another, and we're able to pounce on those and take them. And of course, the deal still needs to make sense for us, but there's a lot of people that have sensible deals, very conservative underwriting, very promising deals that they just can't get it done. So we've definitely seen some opportunity there.
Yeah, we had a deal just a couple of months ago fall out of contract because the financing changed like at the last minute. Luckily, our escrow money hadn't gone hard yet, but the bank came to us and said, "Hey, from the loan committee, we're going to have to change your terms to this." And I was like, "Okay, this doesn't work anymore." So it's interesting times for sure with what rates are doing. Maybe you could touch on that a little bit. What do you think the economy is going to look like in the next 18 to 24 months? And how do you think mobile home parks will fare, given all of that?
Yeah, I mean, if I had a crystal ball, I'd be making a lot more money than I do now. So, I mean, anything is possible. I can tell you that what we've seen and what we're doing is we're going in with our underwriting and our debt terms a lot more conservatively than we would have a couple of years ago. And I know everybody says they're conservative on their underwriting, but if we're getting bridge debt on any of our properties now, we're certainly buying rate caps. I think years ago we would have been willing to roll the dice and not do that. We're going in much lower leverage, even on a property that maybe we could have gotten 75 or 80% LTV right out of the gate. We're not doing that anymore. We're targeting that kind of 60 to 65% LTV. It just gives us a lot more options. I mean, certainly we hope that even if rates continue to climb, that they will creep back down again by the time we're ready to exit or refi. But if it's not, just going in much lower leverage just gives us more flexibility when it does come time to refinance or sell. And that's tough because the lower leverage you have, the more capital you have to bring to the deal, the lower those promoted returns are in our advertising and in our marketing. But we just sleep a lot better at night knowing that we've kind of taken those additional conservative measures. So if the economy stabilizes and people are okay with it and rates stay somewhat realistic, then great. That's just more meat on the bone for us. If things continue to go sideways, then we feel that we're pretty protected. I mean, let's face it, mobile home parks are generally standard workforce housing, and there always seems to be a demand for that. I think that's why both of us, you and I, are in this business, is no matter what economy, there's always a demand for that. And if it comes to a point that there isn't anymore, then we've got problems presumably way worse than hitting returns. But we try to be very responsible stewards of our investor capital and make sure that we're not overpaying and we're not going in over leveraged on anything. I know, like early in the year, when we launched the fund, I think we raised $30 million in less than a week. It was really simple for us, as it has been. We've got our golden goose, Brandon Turner, who will just post on Instagram that we need some money, and then it all comes in. What was around April, May, June, when stocks and crypto and started to slide and interest rates increased, we saw a noticeable difference. And all of a sudden, it was a little harder to raise money. Instead of just watching it walk in through the door on its own, we actually had to be a lot more proactive. Spent a lot more time on the phone with investors. Had to sharpen our pencil on our underwriting. You mentioned, I think even before we got on this, but we were doing a lot more actual advertising, which we hadn't had to do before, between Facebook ads and Google ads and all that stuff. Just a larger outreach and try to widen our net. And we were able to do it, but those few months where it was something that we hadn't seen before. And I think even as recently as this month on our most current raise, that initial panic from the market pullback seems to have subsided. People are like, okay, things are not like they were 6 or 8 months ago, but the world hasn't completely fallen apart yet. And we're seeing that ease of capital raising again. So I don't know. Does that get better? Does that get worse next year? We're bracing for it to get worse, and obviously hoping that it gets better.
Yeah, I do think the mobile home parks are moated, and I'm not to say that they won't be impacted at all, but I think the resistance of the asset class has been proven, right, from previous recessions. So we'll see kind of how that plays out. Back to your history with mobile home parks. What mistakes in mobile home park investing have you made that we could learn from?
Yeah, I think it's the one that, like, if I go back to even my early days of just managing other properties and either being in charge of the management or kind of helping the owners do it is just like under budgeting for CapEx stuff. And I think in any asset class that'll bite you, right? And that's probably a very common mistake. But between infill and surprises and failed infrastructure, if you haven't done adequate due diligence, like you got to put in whatever you think it's going to be, and then a significant buffer on top of that, because I've seen parks go very bad very quick just because they were undercapitalized. Thought that they would hit the ground running and didn't, and that's again why I think we tend to be very conservative on our reserve capital, and again that negatively affects investor returns. So it's a delicate balance, but we want to make sure that we do not get blindsided with anything, and we do a ton of due diligence up front. And I'm always thankful that I had started and learned these lessons on the smaller properties years ago, because those mistakes are generally survivable when the dollar amounts are small. Yeah, but you get caught up in over your head on a $10 or $20 million property, and those mistakes get a lot more costly. So good to bang your head and stub your toes early on the cheaper stuff, so that by the time you're on the bigger stage, you're older and wiser. I certainly am.
That is a great tip. This is a question I ask all the operators that come on the show, and it's our the listeners' favorite question. What are the most important things that passive investors, we're talking LPs, need to look out for when investing into mobile home parks?
There's a lot of answers to that, but I would give the same advice for any sponsor, whether it's mobile home park, multifamily, self storage, whatever. Is you really got to put a lot of focus on the team, on the operators. I mean, you can second guess somebody's underwriting all day long till you're blue in the face, but ultimately you need to rely on your team. You're giving your money to people who will have complete control of it. I mean, it's generally a very illiquid investment for on the LP side. And so I know when I'm investing in other people's deals, I want to know the team, most often personally, because I have prior relationships with them. I certainly want to know how long they've been in operation. I want to know what their experience level is. There's some great operators out there, but I've been seeing some stuff, especially recently, that you look at the returns or whatever the goal is, and you're like, man, these are crazy great returns, and then you dig in a little bit and realize that it's those operators' first deals, and they've underwritten rent growth to be on par with what we've seen for the past 3 or 4 years, and a bunch of other stuff that the red flags just immediately start going up. So definitely I want to know about the team. I want to know about the experience, the track record. I always like to know how much the GPs are throwing in of their own money right alongside the LPs in LP shares. And I know we personally, as general partners, invest in all of our deals on the LP side. Not all operators do it, and because they don't, doesn't necessarily mean it's a bad thing. But I feel a lot more comfortable when I know that the GPs have significant skin in the game. So they've got a lot at stake, both from the GP side, and if the thing goes bad, like, they stand to lose probably a lot more money than I do as the investor that invested my capital. So
great insights there. You brought up one thing about rent growth numbers, and I wanted to ask, what is the appropriate or customary amount you feel comfortable raising rents year 1, 2?
Sometimes what looks good on a spreadsheet doesn't play out well in real life. So, I mean, there are some operators, and Andrew, if you're one of them, I apologize, but go in there and just double rents on day one because it makes your numbers look great. And
I don't want to end up in the newspaper.
Yeah, that's exactly it. That's one of the huge points is I mean, we do try to maintain some level of humanity, and these are actual people. A lot of them have been long-term residents, and maybe the previous owner hasn't kept up nearly like they could or should have with gradual rent increases. So we've certainly acquired some deals where on paper justifiable to all the comps in the area. We can go in and double the rent on day one, and we're still under market. But we don't want to displace and ruin people's lives, both from the humanitarian aspect, and if you double their rent and they can't afford that, maybe half your park's going to be empty within 6 months. So that's no good. And then certainly the bad press that goes along with that. Like, we don't want to end up on the 6 o'clock news. Nobody does for those reasons. So we obviously we take it each market at a time, and the overall situation of how low the rents are. But we really try not to go up any more than $50, $75 a year on rent. Sometimes it's less than that. Sometimes, it might be 35 in the first year and then, 25 each year after. But we try to be very, very sensitive to the overall situation. I mean, we're running a business. Obviously, we are. Costs for everybody are going to the roof on everything. So your project needs to be viable, but we try not to push the envelope and hurt anybody any more than we have to.
Yeah, same here. And it's crazy because apartment rents just keep climbing, right? And there's no like remorse there, right? But on the mobile home park side of things, there is this stigma around raising rents to market. So
yeah, certainly. But if we have a vacancy or infill a vacant lot, I mean that one's fair game, right? You can set your price at whatever you want for a new incoming tenant, but we certainly try to be sensitive to those existing residents.
What does the perfect mobile home park look like in your eyes, and why?
One that we just sold for like 10 times what we paid for it would be great. No, okay. I mean, we have a pretty standard buy box. I mean, that 100 lots or larger, we want public water, public sewer. We don't want to deal with any private utilities. We want a solid SMA, so 100,000 people or more within, say, a 10-mile radius. And we want that population to either have been steady, preferably increasing significantly over the past handful of years. And that 20 to 30% vacancy. I mean, we need that value add component. We're not out there competing with the institutional buyers for these turnkey, 4% return parks. It just doesn't fit our profile. So yeah, I mean, we're pretty dialed in on our criteria and what we want, which is something that we weren't originally. And for people that are getting started in this business, I think our net was way too wide. We're looking at pretty much anything and everything. So from 30 to 50 lot parks with septic and wells, which people do well with those too. We realized quickly that we didn't want to buy anything with private utilities, but it was taking up a ton of our bandwidth just trying to underwrite. So it wasn't until we really dialed in our criteria to what I just mentioned, 100 lot park, public water, public sewer, and the population statistics, like that weeded out 80% of the noise in our world. And we were able to actually focus on what we knew that we wanted to buy. And your criteria will be different for everybody. But we knew what worked for us, and we were able to just run much more efficiently, especially on the acquisition side, when we just quickly got to a no on a lot of the properties that were coming across our desk.
That's very smart. What do you guys underwrite to? Like, do you have like an end of year one or an end of year two type of cap rate that you target?
Yeah, you have to bring on some of our underwriting team members to get that far into the weeds. I'm pretty far removed from the day to day at this point. I know that cap rate going in really, I mean, it matters, but not that much because we know we're going to change it immediately, either through the management efficiencies or infill. Our general projected returns, we're projecting typically a 5 to 7 year hold and a 16 to 20% IRR over that period and a 7 to 8% pref. So again, that varies depending on what we're doing. The reason we like the fund model is because we can, if we put 5 or 6 properties in one fund, there may be a mix in there of properties that we couldn't buy individually. Maybe you do go after a more stabilized one. The infill potential isn't there, but man, it's in a great market. The chance for appreciation is there, but the overall returns are so low that we couldn't buy that on our own. But if we blend that with 1 or 2 other more value add parks, I mean, they still have to be good buys, but something that's more value add, that cash flow generally in the early years is not there, just due to the capital intense nature of a turnaround. But if we can blend different profiles of parks and achieve our overall fund level return, we love to do that. It just gives us a lot more flexibility and buying power because we can go after parks that we no way that we could or would want to buy on their own.
That's smart. Yeah. Having a fund to be able to balance that out is very beneficial.
Yeah, allows us to diversify a lot more as operators, and I think it's a lot less risky for the LPs, and you've got diversification across multiple properties in multiple markets and different profiles.
Totally. On the infill that you guys target, are you guys paying for the vacant lots? Do you guys pay for some of that? I get that question a lot from other operators.
Yeah, I mean, generally no. I mean, if the lot is not generating any income, it doesn't affect the NOI, and then we're not going to pay full price for a lot that's not generating any income. Do we sometimes pay a small premium for that because we realize the potential? Sure, that goes into the mix. What I really get a good laugh out of a lot of times is you'll buy a park and and hey, it comes with 30 extra acres that you can double the size of the park, and they'll try to price it on that. And I mean, number one, we're not in development anything, and again, there's a lot of money to be made in that. That's just not what we do. So we're definitely not adding any value at all really to additional development acreage, except in very, very specific examples. But yeah, so the vacant lots, they're worth something to us, but we don't price them as if they were fully occupied and functional. Of course.
Gotcha. Yeah, that's the same with us. There's lower hanging fruit out there, buying from mom and pops and adding value than developing new, because it's very expensive and just an easier base hit. Well, Ryan, I'm very thankful that you came on the show. If any of our listeners would like to get a hold of you or Open Door Capital, what's the best way for them to do that?
Sure. Our website's probably the best place to start. It's ODC, like Open Door Capital, Fund, F-U-N-D. So odcfund.com. You can email me, Ryan, R-Y-A-N, at odcfund.com. And I'm on most of the social media, Facebook and Instagram, if you want to see mostly non-real estate related stupid things that I do during the day. So you can catch me in any of those spots.
Awesome, Ryan. Well, thank you so much for coming on the show.
Yeah, I appreciate you having me, man. Thanks so much. It's great chatting with you.
That's it for today, folks. Thank you all so much for tuning in.
Would you like to see mobile home park value add projects in progress? If so, follow us on Instagram at Passive MHP Investing for photos and awesome videos from our recent mobile home park acquisitions. Once again, that's at Passive MHP Investing on Instagram. See you there.